Welcome back. Deutsche Bank shares stabilizing this morning, up 3% this week. This coming as the bank announced it will sell its Abbey life insurance unit. We want to bring in Dick Bove, equity research analyst at Rafferty Capital Markets. Dick, it's great to see you.
Hi, Maria.
You know, I want to ask you about Wells Fargo because I really enjoyed that most recent report you wrote on Wells Fargo talking about that this is just the beginning. But let's start on Deutsche Bank because there's a real worry out there that given the trouble around Deutsche Bank, it's going to blow up and it's going to impact the entire financial services sector. Are you worried?
Well, I took another strong look at the company's balance sheet this morning, and it doesn't appear to me that the company is in a position where it's going to blow up. In other words, its loan volume is weak. Its expenses have been coming down. Capital markets business isn't very good. But when you look at the balance sheet, there seems to be enough equity. There's plenty of, if you will, room if they do the bail-in on the bonds. So there doesn't seem to be any reason to fear that it's going to blow up. And the other thing I look at is what's happening to the overnight rate, what's happened to LIBOR, because if there was any stress on Deutsche Bank, which was going to be communicated to the markets, those interest rates would be moving up relatively sharply, and they're not. They're staying at exactly the same place. So I think it's a big mess in the stock market, obviously, but I don't think Deutsche Bank is close to blowing up.
Okay.
Dick, the big issue here is the $14 billion fine that's been levied. How far down do you think Deutsche Bank can negotiate that fine? They said they're going down, but it's not clear how far they can get it.
Well, they have to negotiate it down absolutely very dramatically to $2 to $3 billion. And I think, if you think about it from the standpoint of a German, you have this foreign country that's coming in here that's forcing your biggest bank to get rid of, businesses and to fire people in order to pay a fine to this foreign country. And who's the biggest winners in this situation? Well, the banks in the foreign country, which will take market share from Deutsche Bank, and the treasury of the foreign country, which is going to get $14 billion. It just is not going to happen. It's not going to happen.
Yeah, I mean, the company, the stock is down 20% since the September 15th Wall Street Journal report that the Justice Department is seeking that $14 billion. Look, is there a capital problem? Are they going to be able to pay the Department of Justice $14 billion when people are all questioning whether or not they have enough capital just to operate?
Well, I mean, they have what is called, a 10%, I think it's 10.2%, or actually 12%, what is called common Tier 1 equity ratio, right, which means that the regulators think it's got plenty of capital. If you knock $14 billion off that capital, which is 20% of the capital, you got a capital problem. Right. You got a significant. So, do you really think that Germany is going to let the United States do that to the biggest bank in Germany? I just don't believe it will happen. But if it does happen, you're absolutely right. There is a significant problem.
Okay. Dick, I want to move on. I want to talk about Wells Fargo. John Stump is going to be appearing before the House Financial Services Committee today. What does he have to say? Is the clawback him, giving back $41 million, is that enough? Can he keep his job?
I think he can't say anything because anything that he says which is meaningful will result in lawsuits, right? If you think about when Lloyd Blankfein talked to the head of Goldman Sachs in 2009, he didn't say anything either. In other words, these guys have to stonewall because of legal issues. And I think that could be enough to move Mr. Stump out of his position. I think that what Wells Fargo has done is so horrendously bad for the banking system that it's beyond belief that they would do it. Because I don't really care any longer about Wells Fargo because they deserve whatever they get. What really bothers me is they've now set off a witch hunt, for the whole banking industry. I mean, there was 3 hours of hearings yesterday on bank regulation in the House of Representatives. And these guys want to break up the banks. They want to investigate the banks. It's almost as if you're back to 2008. And Wells Fargo did that. And I think, if Wells Fargo gets punished meaningfully, great, because they really have harmed everybody else.
No, it's true. And then even yesterday on the Hill with Janet Yellen, she committed to more oversight on the banks because of this and checking the banks if there's anything going on like this at other banks. So, Dick, you wrote in your report a week ago, this is just the beginning. What does that mean?
Well, for Wells Fargo, it means that there has to be a thorough reanalysis of its human resources policies, of its underwriting policies, and of its IT control systems, because obviously the human resource policies didn't exist that would be effective. They did put out 565,000 credit cards without underwriting them, and they had all of a sudden 1.5 million checking accounts that nobody seemed to be aware of that had no money in them. So this is a significant breakdown in the internal functioning of that company, and therefore I think, you know, bringing in Sherman Sterling and other companies to take a look at what they're doing, I think having this independent board of directors, you know, coming together to take a look at the company is absolutely critical, and I think it's going to take 2 to 3 years to straighten out the problems at Wells Fargo. But again, the problems that they've created for the banking industry is substantial. The Henseling bill that would have eased regulation on banking is pretty much dead. You can't get it through. Getting the Consumer Financial Protection Bureau into the control of Congress and out of the Fed is probably not going to happen now. The likelihood of more capital requirements, you know, coming out of the Fed, and we saw this guy Tarullo the other day, a couple of days ago, speak at Yale, and he's going to put the squeeze on the big banks again with more capital, and he's offering nothing to the banks that are under $250 million. All he's saying is, we want better control of your companies. So all of this has happened because Wells Fargo tipped it in the wrong direction, and it's just wrong and it's bad.
Yeah, you make a good point. All of that, you know, PR and work to try to tell the world that the banks are doing a good job, and now this. So since we're here, do you think other banks are doing this? Do they have that kind of aggressive sales tactics that we could find out it's the same thing elsewhere?
Well, there's no doubt about the fact that every other bank is cross-selling. I mean, that's a core part of the way. I mean, if you walk into Macy's and buy a suit, they're going to tell you this tie goes with the suit. If you walk into McDonald's, they're going to ask you if you want the French fries. If you walk into a bank, they're going to say, have you thought about a car loan? So the net effect is cross-selling is a core of how you sell the product. There have been banks like Fifth Third a number of years ago that crossed the line in terms of pressure on employees to result in bad results, if you will. But I would find it hard to believe that a company like J.P. Morgan or Bank of America or even Citigroup is putting on this type of stress to their client base. I just don't. I would be shocked if they find out that is going on.
All right, we will leave it there. Real quick, Dick, any picks? What stock would you buy in this sector right now?
Well, I'd mortgage your house and buy Bank of America. The stock is so cheap, it is mind-blowing.
Okay, well, look at that, Bank of America. Dick Bove, always a pleasure, sir. Thank you.
Thank you.
We will see you soon.